All right, welcome back to the deep dive. We're jumping into something today that might surprise you a bit.
Yeah, something with potential ripples, big ones, across the whole global economy.
You're probably hitting closer to home than you think. We're talking about Japan's economy.
It's easy to keep our eyes fixed on, the US or China, but there are signals coming from Japan, signals that need attention.
Definitely. Our guide for this is an analysis by Andre G called Japan's Economy is About to Shock the World.
And our mission here is, well, pretty straightforward. We want to unpack that analysis,
Look at the key stress points in Japan's economy.
figure out how that might ripple outwards across the globe.
And most importantly, what it could actually mean for you.
Because honestly, the idea that the next big global tremor might start in Japan, that's not the usual narrative, is it?
Not at all. And understanding how these technical things, bond yields, currency trades, how they could actually impact, say, your mortgage rate.
Or your investments.
That's where it gets really interesting. So let's dig in. First up, why Japan? I mean, globally, their population is only about 2%, right? How do they punch so far above their weight financially?
Well, it's not about population size here. It's about money. Japan is one of the world's biggest creditor nations.
Meaning they lend out a lot of money and own a lot of foreign stuff.
Exactly. They're a massive global financier. Think about this. The source says they hold over $1 trillion in U.S. government debt alone.
$1 trillion. Wow.
Yeah. And their total net foreign assets that include U.S. stocks, corporate bonds, real estate, all over the world, that's over $3 trillion.
Okay, so $3 trillion in assets, $1 trillion in U.S. debt. They're deeply woven into the global financial system.
Deeply. So, yeah, what happens economically in Japan doesn't stay in Japan. It matters everywhere.
All right, so if they're that important, what are the warning signs? What symptoms does the analysis point to that suggest trouble?
There are a few key things. First, weak growth. GDP actually declined in the first quarter of 2025, according to the source.
And big companies are feeling it too.
Yeah, warnings coming out from major corporations, especially big names in the auto industry. That's a red flag.
And it's hitting people's daily lives, not just corporate spreadsheets.
Definitely. Persistent inflation is another symptom. The source mentions surging rice prices, which is a huge deal in Japan. It's a staple food.
Ouch. Yeah, that hurts affordability.
It does. But maybe the biggest, most fundamental driver underneath all this, it's their demographic crisis.
Ah, the aging population. We hear about that a lot.
It's extreme in Japan. They have the world's oldest population, about 30% are over 65.
30%.
And at the same time, one of the lowest birth rates. So the workforce is shrinking fast.
Which must create a huge squeeze on government finances, right?
That's a core point in the analysis. You've got rising costs, pensions, healthcare for more elderly people, and fewer working-age people paying taxes to cover it all.
So less money coming in, more going out.
Precisely. And the projection mentioned is stark. Japan could lose 20 million people by 2050. That's a massive demographic shift, putting immense pressure on the economy.
And that pressure, that demographic crunch, feeds right into their debt situation.
Correctly. Japan has the highest debt to GDP ratio in the developed world. It's over 260%.
260%. How have they managed that for so long?
Well, for decades, they've relied on two main things. First, keeping interest rates near zero, basically free borrowing.
Okay.
And second, the Bank of Japan, their central bank, has been buying up enormous amounts of government bonds, at points up to half the entire market.
Wait, their own central bank bought half their debt.
Yeah, it kept borrowing costs incredibly low, making that huge debt pile manageable.
But the analysis says that model is breaking down now in 2025.
Exactly. It says the model is starting to collapse. The Bank of Japan is signaling it's pulling back from buying so many bonds. And interest rates are finally starting to rise in Japan.
Okay, and that's the trigger point, isn't it? When Japan's internal situation starts potentially causing global waves.
That's the connection.
Yeah.
Because those super low Japanese interest rates were the bedrock for something called the yen carry trade.
Right, the yen carry trade. Can we break that down? It sounds complicated.
It sounds technical, but the basic idea is actually pretty simple. And it's been a huge source of global funding or leverage for maybe 30 years.
Okay.
Investors borrow money in Japanese yen because the interest rate in Japan has been almost zero. super cheap to borrow.
Borrow cheap yen.
Then they convert that yen into other currencies, like U.S. dollars, where interest rates are higher.
And invest it there.
Exactly. Invested in assets abroad, U.S. stocks, bonds, whatever, that offer a better return than the near-zero cost of borrowing the yen.
So you pocket the difference between the higher return you earn and the tiny cost of borrowing.
Precisely. The source gives a 2023 example. Borrow yen at basically 0%, invest in U.S. assets yielding 5%. That 5% spread was almost risk-free profit as long as exchange rates cooperated.
A global money machine built on cheap yen.
You got it. But it only works if Japanese interest rates stay low and the yen stays relatively weak.
And now rates are rising in Japan, and the yen might strengthen?
That's the key. As the Bank of Japan raises rates, it makes the yen potentially stronger.
So what happens to the carry trade then? It unwinds.
It starts to unwind, yeah.
Yeah.
If the yen strengthens, suddenly it costs investors more of their foreign currency earnings, like dollars, to buy back the yen they need to repay their original loan.
So the trade becomes expensive or even loss-making.
Right, which forces them to sell those foreign assets they bought, the U.S. stocks, the bonds, to cut their losses or just get out of the trade.
And the source says we're already seeing signs of this unwind happening.
It does. It points to things like sell-offs in U.S. assets, pressure on Japanese stocks, and unusual movements in global markets, even mentioning things like Bitcoin and U.S. equities reacting.
Okay, so the carry trade is one big channel for global impact. What about Japan's own government bond market? Is it showing stress?
Oh, definitely. The analysis highlights rising interest rates there, too. Yields on 30-year Japanese government bonds are going above 3%.
Which sounds low compared to elsewhere, but for Japan.
For Japan, that's a significant move after years near zero, and 40-year bonds hit a historic 3.6%. Investors are demanding more return to hold Japanese debt now.
And are they finding buyers easily?
That's the really worrying sign. The source mentions bond auctions are failing. The government tries to sell new bonds, and there aren't enough buyers at the price or yield they want.
Wow, that signals a loss of confidence, doesn't it?
It does. The analysis calls it a dangerous turning point. Japanese government bonds used to be seen as like the ultimate safe asset in Asia.
And now?
Now they're looking more volatile, more risky. That's a big shift in perception.
So if these traditionally super safe government bonds are looking shaky, where does that push investors? What alternatives are they looking at?
Well, the analysis notes a potential shift towards what you might call hard assets or alternatives.
Okay. Like what?
There's a really interesting example given. A Japanese company called Metaplanet. They decided to hold Bitcoin on their balance sheet.
A publicly listed company holding Bitcoin.
Yeah, and their stock price surged. The interpretation in the source is that investors were maybe using Metaplanet stock as a way to get exposure to Bitcoin, perhaps as a hedge.
A hedge against what? The yen? The bonds?
Potentially against instability in the traditional financial system there. It suggests some investors are looking for assets that are finite, decentralized.
Things that central banks can't just, print more of.
Exactly. Assets perceived as outside the direct control or potential manipulation of governments and central banks. It hints at a growing distrust, maybe, in the traditional system.
Okay, carry trade unwinding, stress in their own bond market. But the source mentioned one other risk, potentially even bigger, tied to those huge foreign holdings Japan has.
Right. This is the risk that Japan starts selling off its massive holdings of U.S. Treasury bonds.
Why would they do that? Especially if it causes global chaos.
Well, think about it from the perspective of a big Japanese pension fund or bank. For years, they invested trillions overseas because rates at home were basically zero. But now, interest rates are finally rising in Japan. Suddenly, investing back home looks more attractive. They might get a decent return without the currency risk of being overseas.
So they bring the money home, repatriate the capital.
Exactly. And to bring that money home, they likely need to sell the foreign assets they hold, including potentially large amounts of those U.S. Treasuries.
Okay, connect the dots for us. If Japan starts selling, say, hundreds of billions in U.S. Treasuries, what does that do? What does it mean for you listening?
It's pretty direct, actually. If a huge holder like Japan sells massive amounts of treasuries, it floods the market.
More supply means lower prices for those bonds.
And lower bond prices mean higher yields. And treasury yields are the bedrock for U.S. interest rates.
So Japanese institutions selling treasuries could directly push up U.S. interest rates.
Absolutely. Which means higher mortgage rates for homeowners, higher interest on car loans, credit cards, and it makes it more expensive for the U.S. government itself to borrow money.
Wow. A direct link from Tokyo's financial pressures right to your monthly payments.
It's a very real possibility outlined in the analysis.
So it really feels like Japan's situation, driven by these unique demographics, the decades of zero rates, the huge debt, it's acting as a sort of microcosm or maybe a leading indicator for broader global shifts.
I think that's how the source frames it, yeah. It's not just about Japan. It represents the potential end of the whole easy money era we've lived through globally for decades.
The era of near zero interest rates is fading.
It seems to be. And as rates rise globally, it puts pressure on all the debt that's been built up.
Mhm.
So to unwind trillions of dollars in leveraged financial bets that relied on that cheap money.
There's a quote mentioned in the source from Lynn Alden.
Yeah, it's quite pointed, she says, essentially. With high global debt and broken demographics, the only way out is devaluation. It speaks to the fundamental pressures many developed economies are facing, not just Japan.
Okay, let's try to pull these threads together then. If we look at the big picture from this analysis, what are the key global impacts or takeaways we should be watching?
The source lays out a few key points. First, this idea that global leverage, all that borrowed money sloshing around, is unwinding. It might be slow, maybe messy, but it's happening.
Okay, leverage unwinding. What else?
Second, a real risk of a global recession. And the interesting angle here is that Japan, not the usual suspects like the US or China, could potentially be the trigger.
A Japanese-led recession. That's a contrarian view.
It is. Third, we might be seeing a significant reallocation of capital, money moving, potentially, away from traditional fiat assets currencies, bonds towards alternatives.
Like the hard assets, the Bitcoin example we discussed, driven by that potential distrust.
Possibly. And finally, the big takeaway for anyone invested or just trying to navigate the economy. Caution is warranted. Markets look fragile.
And a major player, Japan, a cornerstone of global finance for so long, is showing clear signs of stress.
Yeah, when a player that big starts to wobble, everyone needs to pay attention.
Wow. Okay, so we've covered a lot. The demographic time bomb, the incredible debt load, the end of zero interest rates, the yen carry trade unwinding like a coiled spring,
The stress in their own bond market, investors looking for alternatives.
and the huge risk of them potentially selling off U.S. debt, which directly impacts interest rates for everyone.
It's a complex web, definitely, rooted in Japan's unique history and policies, but with these really tangible global consequences.
And understanding that web, understanding how that global financial plumbing works and where the pressure points are, that's really valuable, isn't it? It shows how interconnected everything is.
Absolutely. What happens in the Tokyo bond market isn't just an abstract headline. It can genuinely influence your financial life, wherever you are.
Which leaves us with a pretty potent thought, drawing on the source material. If an economy like Japan's, known for stability, known for decades of, frankly, managing the unmanageable, is facing these kinds of deep structural issues,
Issues serious enough that investors there are actively looking for escape hatches outside the traditional financial system.
then what does that imply about the long-term stability of those traditional systems everywhere, in a world grappling with similar, maybe less extreme pressures of debt and demographics?
Where do you find real durable value when the old certainties seem to be shifting under our feet?
Something to definitely think about.